kind of before we get started, maybe some small announcements. I've got Susie Ray. Did you want to give just a few comments on here? We get a chance. So, Susie, if you would.
Just a few key takeaways. The crop insurance period starts really right now and goes until March 15th. A few changes are the early plant date for beans is the same time as corn. So it's April 5th. If you take out a replant option that we have, you're able to plant 15 days prior to that for both corn and beans. But other than that, we'd be happy to look over your crop insurance policy and whatnot. But I got Peggy Dusterhouse in the back, and we've also got a few folks from Missouri that also do crop insurance as well. So thank you guys for coming.
Yep. And with that, we're going to jump right into things on here. So our guest speaker tonight is Brian Burke with JSA. Many of you know Brian. Brian's local. He's going to have all the answers. He's going to tell you exactly when the high's in, when to sell, when to participate. So take good notes. Take good notes. Notes furthermore, Brian.
Well, I guess we're going to start off with the biggest lie of the night right there. That's not going to be the case. I did already have the question, when are we going to see $8 corn again? So, I mean, we're just letting the good questions fire right away. So that's good. No, I always appreciate doing this meeting. This is always coming back home. It's a lot of fun. See a lot of familiar faces, classmates and so forth. It's always fun to come back and do that. So, you know, markets, before I kind of get into just some of the formalized, you know, presentation part, you know, we're in a period of time where it's similar to the period of time we had from 2008 to 2012. So if you think about how prices in general, farming returns in general, have some cycles to them, we're in a cycle right now that is similar to the 08 to about 2012 that was extended by that drought year cycle that was really ethanol driven and China soybean import driven. And we're in a cycle today partly because of the Black Sea, partly because of some policies on the renewable diesel side are fueling some of the soybean valuations, especially for soybean oil. And we're continuing to see some weather challenges going back and forth between Northern Hemisphere and Southern Hemisphere that just haven't allowed a really good back-to-back global crop that has supplies pretty tight. So all of those things are kind of leading into a pretty good cycle that I think we're in the third year of. I like to remind folks that I think that 08 to 2012 cycle was extended by that drought year in 2012, and a 3 to 4 year cycle is about normal for an extended high period of time or an extended low period of time if you look back over history. And we're getting to the second half of that cycle, so it is important to kind of remember that high prices do their job just like low prices do their job as it relates to production and supply and demand balance. So we are, in general, I'm not overly bearish the next crop year, the crop year we're going to plant this spring. I think we're going to have a lot of opportunities for the fall of 23. What I am the most worried about today is 24 and how we could fall off coming after this crop year. So just some real quick high-level stuff as an intro. I like to keep this as informal as possible, so if you've got questions anywhere along the way, just holler them out. I'm going to skip this first slide because you guys kind of know what we're doing, or who we are anyway, because I've been here, I think this is the 10th year in a row, so it's been here a few times. This is just an overview of the presentation. I like to start off with acres, and I've shown this slide a few times. Can everybody hear me okay? I should have said that first. Is the volume good? A little higher? Hold on. Is that a little better? Okay. I like to start off with acres because I think it's important to keep in mind just what the trend of U.S. acres is and what the trend of acres in South America is as well. I don't typically, I mean, I am on this slide, but I don't typically just read some things off of the slide. I kind of talk over them. But I want to point out a few things. We've lost, in the last 20 years, a little over 20 million acres a wheat, actually about 17, 18 million acres a wheat in 20 years. We've had CRP acres go from 34 million down to 22 million this last year. We've had corn and soybean acres, when you combine them, have gone from 152 million acres 20 years ago to 176 this year. The high of the corn plus soybean acres is 180 million. So we've had some macro switches away from wheat, less CRP. The biggest acreage pickup has been corn and soybeans. We've never got over 180 million acres in the past. And I don't know that we're going to do that anytime in the future when you add these two together. I've got, the most acres of corn we've ever planted was in 2012. the drought year. We had a really early spring, it was dry, everything got in early, and we started that year at 6 whatever corn, and we planted 97 million acres. The most beans we've ever planted was 4 years ago at 90.2 million. But the most combined corn and soybean acres we've ever planted is 180. And it is going to be very, very difficult to get above that number. We're going to have an acreage report coming out in March. That has usually got a bunch of people's guesses on, did we buy corn acres? Did we buy bean acres? What have we done with that? I'm going to tell you our guess today. We're going to be 180 million acres. It's going to be maybe 92 corn and 88 beans, or 90 beans, 90 corn, but it's very difficult to get above 180 million. If you look at total acres, which is on the right-hand column here, with CRP and prevent plant added back in since we've started prevent plant acres, we are losing about 700,000 acres a year in this country on average. If you take all principal crops and CRP and prevent plant, we were 360 million acres 20 years ago. Today that's 344. That trend is not going to change. We are planting windmills, we are planting solar fields, we are planting larger cities, smaller cities getting larger, urbanization. All of that continues to take away cropland every year. And that's not going to change in anything that I see. We are going to continue to lose net acres in this country for principal crop production. And I think it's important to keep that frame of reference. It doesn't mean we're going to produce less. We can trendline yield our way out of some of that, or keep improving yield and production advancements. But that's a stark disadvantage that we have to South America. South America continues to have significantly more land that can go into production that is not in production today. And on average, we're seeing 2 to 3% more acreage in Brazil every year. And that was 5 or 6% more acres in 08, 09, 2010, 2011, and we're seeing that kind of advancement again because of these prices. The prices that we're in right now, $14, $15 beans, $6 to $7 corn, that's advancing acres in Brazil faster than the 20-year average. So the advantage that South America has is just simply more acres. Their yield is on an upward trend just like ours is. So try to keep in context that a little bit, because when we go through this particular presentation, we're also going to talk about some of the domestic opportunities that we have, and some of the increases in demand that we have, especially on the corn and soybean front, to use in this country. That's kind of on the bullish side of the equation, I think, for the next few years, especially on the soybean side. If we look at this last year, I'm showing this chart because it's corn production year over year. You can see how much we lost in the West last spring, or last fall. We're down, I think it's over 600 million bushels. 604 million bushels we are off from last year in South Dakota, Nebraska, Kansas, Oklahoma, and Texas. The basis for corn in that part of the country is absolutely incredible. It's Garden City, Kansas. I don't know that they've been under $2 a bushel over for basis since this fall. We have more trains leaving the state of Illinois this year going to Kansas and Oklahoma than we have ever had, and it's only the first 4 months of the marketing year. We have shuttle train clients in Illinois that will typically load 50 or 60 shuttle trains in a year that have already loaded 50 or 60 shuttle trains this year, and we're only 4 months into it. We have clients that have 150 trains on the books already for this year, and they're all moving to the area in the western part of the country that's down 604 million bushels from last year. Those cattle in Kansas still need to eat, and that crop was off 158 million bushels, and for Kansas, that was about a production percentage loss was 22%. And Kansas is a net deficit state. Kansas has to import corn anyway, and now they have to import 22% more than what they did last year, and most of that is coming from the state of Illinois. When you look at the eastern half of the state was also off from last year, which was about 425 million bushels, but the east had a record crop last year. So what we have, I mean, the east is not bad. It's just down from its very good record crop last year. What we have in the United States right now is a pull to both sides. The best crop in the country on a yield versus trend basis was Illinois. Second best crop in the country was the eastern half of Iowa, and then you get into Minnesota. That's where the best corn grown this last crop cycle came from, and we're pulling that domestically east and west at the same time. So the first part of the marketing year is not the time that we typically export a lot of corn. That's typically when we export all our beans. The last half of the marketing year, starting typically, it's usually started by now. We have a late start this year because of Brazil. But from now, typically through June, is when our peak export season is for corn. And we're just barely getting started with that. So it's going to be very interesting how the export market competes coming down the middle of the country when we have such higher basis levels going east and west. Right now, the export market along the river systems is nowhere near competitive with the shuttle loaders and the ethanol plants in the interior part of the country. And I think it's going to be interesting to see how that changes as we go through the next few months. This is also just showing Iowa. I broke down Iowa a little bit more because the western half of the state was significantly worse than the eastern half of the state by about 43 million bushels just in the state of Iowa alone. I'm not going to spend much time on the supply-demand report, just simply because we have a big report on Thursday. And I mean, I know what the report's going to say, but I just can't tell you. I know. So, we're a company that we will slice and dice numbers all the time, trying to find a trend, trying to find a correlation, trying to find something that gives us a little bit of a hint into, you know, conditions like this have typically caused a bullish report, or conditions like that typically cause a bearish report. Trust me when I say there is nothing on January 12th that you have any better than flipping a quarter on whether it's going to be a bullish or bearish report. It is the first measurement of stocks for the year. It's the D1 stocks number, and that D1 stocks number feeds into the first S&D that has the adjusted stocks, and it is also one of the first world outlook numbers for next year. All of that comes at the same time, 11 a.m. Thursday morning. And so it's the biggest data dump of the year. It has produced limit moves about 50% of the time. In the last 10 to 20 years, you can look back, you're going to see limit up, limit down. The reason you have limit moves usually is because you catch the market leaning the wrong way. If everyone thinks it's going to be a bullish report, and you give it some bullish information, you very rarely go limit up. If everyone thinks it's going to be a bullish report and you give them bearish information, that's usually when the limit down happens. So on this report, nobody knows anything. And so we're going to see what it does, and it generally produces about half the time a limit move. This is, for me personally, and I get people that like to trade sometimes, there's a difference between trading and hedging and risk management. There's a very big difference between the two. But around this report is one of the few times I really like to buy a very short-term option. And I'm going to get to that kind of at the end, because that's something we plan on doing in our JSA Select program, which we have some 2-year next fall corn and beans in. You can buy a corn option that's going to be an at the money option right in front of the report. You can buy that call probably for 5 or 6 cents. Now it expires on Friday. It's very short term. It's a weekly call. And those are the types of things we like to do around this report. I mean, I'm not a big gambling guy that wants to put a lot of money on a report that I have no idea it's a flip of a coin. But I'll look at spending 5 or 6 cents on a weekly option just to take a chance on it being bullish or bearish in a big way. And so we do have some trade ideas around that report that are low risk type of trades, but just to share. This report here, if you look at how's the market leaning going into Thursday, this is just a quick scattering of some of the trade expectations. The summary is we're looking for very, very small increases in yield and production of both. Like less than about 10 million bushels of beans, maybe 30 million bushels of corn between yield and acres that we're going to have as the average trade guess for Thursday. That's nothing. That's basically saying we have no clue. And that's truly the way this report should be respected, is it can be quite volatile. The biggest number I like to look at on any supply-demand report that I show in any meeting, I've probably pointed this out in the past, is this stocks to use number here, which is the one that this crop year we're in. This is our ending stocks as a percent of our total usage, exports and domestic demand. When that number is below 10, we are typically in an increasing market, increasing trending market. When it's above 11, it's typically in a downward trending market. When it's 10 to 11, it's usually pretty choppy. So if you were to broadly describe the market that we're in, it's still a bullish leaning market. Now it's a bullish leaning market with a mid-6 in front of the price, so we're already pretty high. But it is still a condition of the market that is pretty tight. If we look at that compared to history, the way this chart here reads, the green bars on this chart is our ending stocks. The yellow line on this chart is our stocks to use ratio. And then I have a red line drawn where we're at this year, right here. And you're gonna see there's only about 4 or 5 years since 1975 that we've been as tight or tighter than this. We are in a tight corn market. We do not have a lot of cushion. Our ending stocks are not very adequate compared to our demand. And the same is true for beans. This is a quick basis slide. I show this to Scott a lot. Scott's not here, Scott Meyer with Ursa. And it's showing this basis anomaly that we have going on right now. And again, this is more just FYI for you guys because you're not in Nebraska or Ohio. But the basis in the East for corn, long-term historical average is about 20 cents above the basis in the West. Right now, and throughout a lot of this summer, we've seen the Western basis $1 above the basis in the East. And it has to do with that Western drought we've been in for the now 3 years. It has to do with that Western production fall off and the amount of money in basis it is taking to pull so much more corn from further east to fill the Western demand. So our Western corn basis continues to be well above the East. If you look at this, is all this is an Eastern point basis minus a Western point basis, and it's graphed. You see how much time we're above zero, which is normally the East above the West, and where we've been for the last year and where we still are. I think we're going to go through the entire crop year with the Western basis well above the East, which is rare, but we're probably going to spend the rest of the crop year doing that. Soybean production, very similar to corn, was down in the West. If you look at the 4 states I have up here in red, that's where our bean production was off in those states year over year. It's about 178 million bushels in those 4 states. The entire country was only down 120 million bushels, but 178 was down in those 4 states. Obviously, we had states that were higher in the East. So we're very disconnected with supply and demand right now in this country. Western crush plant basis, Western feedlot basis, Western ethanol plant basis is all higher than in the center and in the East because of how disconnected we are with that Western drought bleeding into its 3rd year. Soybeans are also still very tight, just like corn. I'm going to go through this quickly. This stocks to use ratio at 5%. You can look and see maybe 5 or 6 years going back to 1975 that we were as tight or tighter than we are now. So we're tight. We do not have a lot of beans. 220 million bushels or so at the end of the year is not that many. That's a tight number when we use more than that in a month. Switching gears here a little bit, I'm going to talk about soy crush and renewable diesel. I've heard a lot in the last year that renewable diesel is like ethanol 2.0. I hear that a lot. I'm not really a big fan of that analogy because there's some very important differences between renewable diesel that comes from soybean oil and ethanol that comes from corn. The biggest difference, I think there's 2 big differences. One of those 2 big differences is ethanol in its usage and in its blending was federally mandated. It was a 2007 RFS that was federally mandated to get our gas supply up to 10% ethanol in every gallon of gas consumed in the country. And that was done at the federal level. Renewable diesel has no federal mandate. Renewable diesel is being pulled in primarily by the state of California, and then a few other states that border California, Oregon, Washington, and we're talking about doing some similar things on the East Coast, but it is a state-driven drive for the value of renewable diesel and the value of vegetable oil. That doesn't mean that, it's still a premium, it's still money, it's still margin, it's just state-driven and not federal, and I think state-driven policies can be a little shakier than federal policies. The other big difference is how the industry is growing in renewable diesel and how the industry grew during ethanol. The plants are in the same places. Ethanol plants, for the most part, are in the Midwest. All these new crush plants that are being talked about, and some are coming online right now, are all in the Midwest. The plants of ethanol that were built in 06, 7, 8, 9, a lot of them were built by farmer co-ops. A lot of them were built by grain elevators that pulled producer money in or co-op money in, or general ag money that came in to build those plants. And then they marketed the ethanol to the refiners, and the refiners fought the ethanol and still fight ethanol tooth and nail today. The Valeros, Exxon, BPs, Mobiles of the world, they don't like ethanol. They don't want ethanol. It's federally mandated, they have to use it, but they don't like it. Biodiesel, or renewable diesel is going to be produced in their refineries. The refineries in New Orleans by Diamond Green, the refineries in Martinez, California by Chevron, the refineries by ConocoPhillips in Texas. Those are the ones that are going to be making the renewable diesel. The crush plants that are in the middle part of the country are sending all the vegetable oil to those refineries to take the soybean oil and convert it to renewable diesel. That renewable diesel is a drop-in fuel. You can add it to the pipeline of a diesel pipeline at any percentage you want because it's diesel fuel. It is not a different product. It's what they call a drop-in fuel. So you could go to the gas pump, grab the diesel handle, put it in your semi. It might have 5% renewable diesel. It might have 75% renewable diesel, and you wouldn't know the difference. There is no difference. That is very different than biodiesel, which is a totally different product. Biodiesel is blended at 5%. It's got some gel problems. It's a totally different product altogether. And biodiesel is made at smaller plants throughout the Midwest. Renewable diesel is the big story. And so renewable diesel expansion by these renewable diesel companies that are building these plants, where they're building them is within their existing refineries that have excess capacity. The reason renewable diesel is being brought in by the oil industry is because this is their green play. This is their way to show the country that we're not the big bad wolf of carbon emissions. We're going to do something that is going to be wildly popular within the green climate change groups because of what we're doing. And they're being kind of genius about it because we all know the trajectory of liquid transportation fuels. That peaked about 5 years ago. Liquid transportation fuels, gas and diesel, are downward sloping. We're only using about 85% of our refining capacity today. We had used over 90% for a while in the 2012 to 15 era. We're taking that refining capacity that's no longer in use because we have more and more electric vehicles on the road every day. And we're taking that capacity and converting it to a renewable diesel refining portion of that same plant. And so they control the production of it. They don't control the production of ethanol. And that's the other big difference between renewable diesel. One of them's kind of a bullish difference, the other one's a little bit of a bearish difference. But the trajectory of renewable diesel has a lot of money behind it. These crush plants today that are getting built, some of the first ones cost about $300 to $350 million. If you're going to start one today, it's $400 to $450 million. Half of that money today is coming from the refiners. The investors in the crush plants being built today and for the next few years, about half of that money is coming from companies like Chevron, Exxon, ConocoPhillips, Diamond Green. That never happened in ethanol. So that's the one reason to think it's got some staying power too, is you've got big oil going in the same direction as a renewable fuel. That's bullish. That's probably the biggest bullish factor in this whole conversation. So what's renewable diesel supposed to look like? This is how much is existing capacity. It's next to nothing. We have a couple under construction. We've got one that started up in the last couple of weeks. We've got planned and proposed stuff that's going to get us up to about 5 billion gallons. That's not an insignificant number. That's a pretty good sized number. 5 billion gallons is 1 billion gallons more than the current renewable fuel standards in the states that are supporting renewable diesel, which is mostly California. So we're doing what we always do in agriculture. We're overbuilding already. So this thing can run its course in a couple of years, and we're going to have a fair amount of crush capacity. We're going to have a fair amount of renewable diesel demand. Where's the veg oil come from? Where does all the bean oil come from? Because if you just look at this chart, you could make the argument that we need about 95 to 98 million acres of beans, which is only going to leave 84 to 85 million acres of corn. Because you're only going to get to 180 combined, right? And I don't know too many producers in the country that want to go that way. We want to go the other way. We want to grow more corn acres than bean acres. That's what we like to do generally. But the drive of renewable diesel actually has us potentially producing more bean acres, less corn acres. I'm not a big subscriber to that for one primary reason, and that is I don't think it means we have to grow that many more bean acres. I think it means we export that many less beans. We're going to grow a similar amount of beans in this country, I think, over the next few years. We're going to export less, as long as Brazil has a decent enough crop to manage the size of the world trade that we have today. So that, in all likelihood, I think we're just shifting a certain amount of our export beans into a domestic pipeline. These next few charts I'm not going to go through very quickly, but it shows soybean oil usage. I do think this is a little bit interesting. So soybean oil is the whole chart here. This is what we use soybean oil for. I mean, you know, if you go down to the plant in Quincy, the main products that come out of that plant is soybean hull, soybean meal, and soybean oil. There's 11 pounds of oil in every bushel of beans. So of that 11 pounds that's in every bushel that goes through any crush plant, most of that, if you go back, this is going back into the 80s and 90s, most of that goes into food. It goes into vegetable oil at the grocery store. You know, if you buy a blended oil at the grocery store, it doesn't matter what brand it is, it's got a lot of soybean oil in it. Over time, we've changed that. You get into this is the year 2010. The blue section of this is biofuels, mostly biodiesel, not renewable diesel, biodiesel. And you also look at the export side, which is the orange that stayed about flat. We continue to use in this country less and less soybean oil for food purposes. And that trend is going to continue. We are going to use more and more of the soybean oil we produce in this country for fuel and less for food. So what are we doing to replace that food oil demand? We're importing other food oils. We're importing palm oil from Malaysia, we're importing canola oil from Canada mostly, and we're importing a lot of olive oil from the Mediterranean countries. So our oil supply, I mean, you've probably seen it on the supermarket shelf. It maybe wasn't your choice, but we have a lot less soybean oil on the supermarket shelf and a lot more olive oil and a lot more canola oil than we ever had, and that's because of this shift. And that is going to accelerate. We're going to have less and less in the next 5 years, and even we do today. So there is some interesting dynamics on the food oil side. This is the crush capacity over the next 5 years, and shows how it's going to grow by over 1 billion bushels with these new crush plants that are coming online. This is the added soybean oil production to the right there in the yellow. It shows that jump up in millions of pounds. It's about 12 billion more pounds of soybean oil over the next 5 years. And then soybean meal production, you're going to get into that 10 to 11 million tons more soybean meal produced in this country than we were prior to this build out. Soybean meal is the highest valued protein feed product out there. I mean, in the country. You could argue some of those sunflower meals or canola meals might have a higher protein content, but they're not that available. So bulk feed products, soybean meal is one of the best out there for livestock. There's a lot of folks thinking that all this soy crush capacity coming online means we're going to need to export a lot more of this meal because we're going to have a lot more of it. I tend to think that that is partially true. I also think we're going to feed a lot more of it. I do see a bit of a resurgence, and I get some pushback on this, so I'm not saying this is an opinion. This is not stated as fact. But we're seeing a lot of change in the livestock industries in this country right now. We're seeing less cattle in Texas, a whole lot more cattle in Nebraska and South Dakota. They're moving up because of water. We're seeing less hogs in North Carolina because it's North Carolina. We're not going to grow that much more livestock in that state, in that populated of a state along the East Coast. We're pushing that back up into Pennsylvania, Michigan, and Ohio. We have some clients in Ohio that have built a feed mill every year for the last 3 years. And it's because of the amount of hogs coming to Ohio. They're coming from North Carolina, so it's not a net gain, but they're migrating closer to the supply of meal and corn. And the cattle movement is because of water. So we're seeing a lot of moving around, but I also think we can see some net increase in the livestock side in the U.S. because we're going to have access to a lot of relatively inexpensive high protein feed. And instead of shipping that feed out of this country, I think we're going to also have some opportunities to ship a lot more meat out of this country. We're shipping protein out, it's just of a different form. I'd rather send it out in the form of a pork chop than send it out in the form of a ton of meal. But I think we're going to see a little bit of both. So we do have a lot of extra feed that's going to be coming online here in the country in the next few years. This is a super busy slide. I just want to talk over this briefly. I'm switching gears back to corn real quick. This goes back to corn exports. Most of you've read over the last 30 days about Argentina's drought. I have like 1 or 2 slides that I'm just going to kind of go over right now. Argentina is in one of their worst droughts they've been at in 20 years. They have potentially, if you take the temperature in Argentina so far in January, and you take the temperature forecast for the next 10 days in Argentina, which gets them out to about the 22nd, 23rd of January, you potentially have the hottest January on record in Argentina. I mean, every day we're getting up 102, 103, 104 in Argentina right now. A little bit of water here and there, but not a lot of rain coming through. They have a real deal drought in Argentina. The meal market is rallying because of that, and the bean market has been supported because of that. The production loss in Argentina versus last year, if we compare it to the 2 other droughts that are really bad in the last 20 years, which was 08-09 and 17-18, those 2 years, soybean production in Argentina was down. One was 17 million tons, one was 19 million tons. They were down a lot. The problem I have with this big rally on the Argentine drought is we have a record crop in Brazil coming of about 11 to 12 million tons above the most they've ever produced, and about 25 million tons above what they produced last year. So even though Argentina is suffering, we will see in the neighborhood of 20 million tons, almost 1 billion bushels, more beans coming out of South America this year than last year. The drought is in Argentina, and it is bad. But the big dog on the block is Brazil, and they're having a pretty good go at it. Okay, so I'm trying to frame up why I think $14.50 to $15 beans is a lot more reasonable in this scenario than what we got to last year on the Brazilian drought, which ran us to $17 beans for a short period of time. I think if we're going to see $17 beans, it's going to be because of problems in this country when we get into the spring and early summer. If we're having some challenges, that may be the catalyst. I don't think there's enough support from the Argentine drought to get us to 1650 to 1750 beans. I think that's a little bit too much of an ask. This chart is corn. I just went over beans and I realized that, but we're also seeing corn cut in Argentina. That is an important thing for us because the corn, there's technically 3 corn crops in Argentina. They have a first season, second season, third season. They like to make a big deal out of having 3 crops. It's really not that big of a deal. It's kind of like us having a Delta crop, a Midwest crop, and a North Dakota crop. Okay, it's just the way the crop moves up and down the country. But their first crop is usually about 20% of their total production. Their second crop is usually 65% of their total production. And you're left with this really small third crop at about 15% or 20%. What is important about that is they typically export a lot of their first crop of corn. And they export that first crop of corn in this blue highlighted area. This is March, and this is Argentina's exports. Last year, they exported 3 million tons in March, 3.9 million tons in April, 3.8 million tons in May. So let's just round that to 10 million tons. There's talk that the Argentine corn crop, first crop, is down 5 to 6 million tons. If it's down 5 to 6 million tons, there's no way they're exporting 10 million tons in March, April, May. The only other game in town in March, April, May is the United States. We're going to have Ukraine clipping along at about 2 million tons. We're going to have some other really small countries like Romania, Bulgaria that ship less than 1 million tons a month. And we're going to see the US at 6 to 7 million tons during that time frame. So as bad as Argentina gets in the next month or so, does create opportunities for US corn exports March, April, May. And so we are looking at that really closely because it has a lot to do with this area that's very export reliant with the river system. And you look at where basis is at for March along the Mississippi River, or River Open, it's significantly higher than it is in the spot market. And that's because we're expecting a very substantial corn export program through the winter and spring. So we do look for basis opportunities throughout the winter, or throughout the spring really. Just some trends here. This is not really doom and gloom, it's just a little bit of reality. World corn trade is in the red line. We continue to trade more and more corn almost every year. This is total world trade. The blue line is how much the US ships. This dashed line that I put over top of all this is the percent of world corn trade that is the United States' percent. It's our slice of the pie. You go back into the 70s, 80s, 90s, our slice of the pie was consistently in the 70-75% range. Our slice of the pie today is 30%. I don't think that's changing. I think it's going to continue to be a downward sloping percentage. I do think our corn export participation out of this country is going to go from 30% to 25% over the next few years. And that is because more and more comes from South America. We have had some muddying of the waters with Ukraine and the war in the recent year, and that muddying may still happen a little bit, and Mother Nature still has a lot to say from year to year, but the trend of us shipping less corn to the world as a percent of the total will likely continue. You look at soybeans, total world trade is in red. South America, which is Argentina, Brazil combined, is in green. The United States is in blue. It's an upward sloping line. We've been shipping more beans, but as a percent of the total, again, we've gone from nearly all beans. You go back into the 60s, if somebody traded beans in the 60s to anywhere else in the world, 99% of the time it came from the United States. We were about the only shipper of beans in the 60s and 70s. But now we're about 30%. Most all of that has gone to Brazil. I don't think that trend is going to be changing either. Wheat's the same way. We only ship about 10% of the world's wheat. So I do think we still have a bullish, lot of opportunity in agriculture. I'm not real bearish on the return per acre. I'm not real bearish on profitability here in the short term. But I do think the theme that we're seeing evolve is the value of our crops are going to be more determined by what we do here domestically than any major export focus outside of this country. Our focus is things like renewable diesel, ethanol, sustainable aviation fuel, which is a little bit further off, that comes from ethanol, livestock and things like that are going to consume a higher percentage, I think, as we continue to go to the future, than trying to expand our markets by exports. It's just very difficult to compete with Brazil's acreage continuing to increase. This is world stocks to use ratio. Don't need to go over that too much. It just says we're still tight all around the world, not just in the United States. This is the Argentina drought. I'm going to skip that. I've talked over all this stuff already. This is showing the South American production about 30 million tons above last year on beans. Again, I've already said all of this stuff. This near last section here is on China. I've been here for 10 years doing speeches, and I don't think for the next 10 years, if you have me back, you can do a presentation without talking about China. There's always something going on with China that's moving the markets. The thing I'm concerned about is China appears to be leveling off with their demand. I got a series of 3 charts here, and I'll just show them to you really fast. There's one thing all 3 of these charts have in common. They're all moving from the lower left to the upper right. Whether it's bean demand, corn demand, feed grain demand, or livestock demand in China, it's all been increasing for the last 25 years. In the case of beans, it's been increasing almost 6 million tons a year from 2000 to about 2017. So we've had a huge bullish China story that we've gone through for 2 decades. The problem I see with China is if you look at these charts, you know, the peak chart here, which is all grains and oilseeds imports, was 3 years ago. The peak chart of beans only was 3 years ago. The peak meat production number from China was in 2014. Now, the problem is we have 3 events that have really muddied the recent few years. We've had ASF, which is African swine fever that hit China really hard, decimated their hog herd. We've had a trade war, and we've had COVID. So you can make arguments that all 3 of those have really made an impact on really being able to see what's going on in China, because all 3 of those things had big impacts on China demand. So I don't want to say China's growth is over. That's a pretty bold statement. But if you look at the recent few years on their imports, they are definitely flattening out. And if, a big if we're not going to see Chinese imports more than 100 million tons of beans, if we're going to see Chinese corn imports flatten out at around 20 million tons of corn, That is not bullish long-term grain prices, because you have the largest buyer in the world flat, and you have the largest supplier in the world still adding supply in South America with their acres. That trend will eventually turn into something that's bearish. So if we are seeing a flattening China, that is a concern. Now I know today and right now people are talking about the Chinese reopen trade. They went against their zero COVID policy and all that stuff, and that's bullish China. It might be for 6 months. They might restock some things in the short term. But we need to see year-over-year net growth and new record imports if we're going to get back on the bullish China bandwagon. Because right now it's not that bullish over the last 3 years. One wild card, and I almost hesitate to say this because it actually goes against an entirely other comment that I just made, but we have a new president in Brazil. He's got like 7 names. I'm going to call him Lula. Lula is the new president of Brazil. He took over from a guy named Jair Bolsonaro. Jair Bolsonaro is the Brazilian version of Donald Trump. Lula is further left of whatever we have in this country today. However you want to describe what we have today. Okay? I'll leave that all up to you to talk amongst your tables. He is an extreme socialist, borderline communist. He's an extreme government control guy. He's been their president 2 other times, 2 different terms that were separated by a 2-year jail sentence. That is the president of Brazil today. Set the stage there. Before he even took office, which was January 1st, January 2nd, before he even took office, he did a climate summit in Australia to the COPA meeting, which is a whole bunch of countries getting together to talk about how they're going to save the planet in the next 3 years. Okay, so the climate conference was in Australia. He gave a big keynote speech, and in that speech, this is what he said. He said, Lula's reforestation plan proposes to either reserve land and or take back and convert back production of land that is equivalent to the size of the state of Alaska. So how big is the state of Alaska in terms of Brazil? Well, it's this red drawn line. It's big. He also said on top of that, we're going to reclaim production land that has already been put into production, mostly for soybeans, that is equivalent to, 12 million hectares. 12 million hectares is 29.65 million acres. 29.65 million acres is equivalent to the size of the state of Mato Grosso, which is in the solid red. That is a outlandish statement that he made. But it's the president of the country making this. I think you got to know who your audience is. Your audience is a bunch of climate people. So he's probably trying to get a rile out of the climate groups to support him. But if any of this, even if a small percentage of these statements are true, then everything I said about China, about Brazil's acreage expansion, 2 to 3% every year and growing, you can throw out the window. Okay? This is a wild card. There's nothing out in the marketplace today that says this is happening. Okay? I don't know if any of it will happen, but this is what he said. And it has a lot to do with the next 5 years of agriculture. If we actually start to see Brazilian land in production shrink. We haven't seen that in 20 years. If we see it shrink. So it's a wild card. I don't really know what to make of it other than to just mention it to you. Price opinions, and then I'm going to be pretty much wrapped up. We like to look at prices in terms of old crop years and new crop years as a relationship to the January 1 price. And the reason we do that is because there's a lot of really good history out there of what is the price of January corn, or what is the price in January of July corn and Dece corn. What is the price on January 1 of July beans and November beans for new crop. And then we take those price moves from January 1 to the high, January 1 to the low, and start to draw comparisons between years. So we can say what years look like this year in terms of stocks to use ratios and things like that, to get a better understanding of what could our high be, what could our low be under these sets of conditions. So where did we start January 1 at? This is really important. Where did we start January 1 at on beans? I mean, if you can read the screen, great, but anybody have an idea how this year's January 1 bean price compares to past January 1s? Don't be shy. It's okay.
Highest.
Highest. Highest by how much? It's the highest bean price ever on January 1st for July soybeans was in 2012 at $13.82. We closed the market on December 30th, Friday, December 30th, at $15.33. Not only the highest, but the highest by a lot, okay? By around $1.50, almost. On November beans, the highest price we've ever been on November beans on January 1st was $12.94, and we did it in 2011 and 2013. November beans this year to start the year were $14.16. Again, highest by a lot. When you look at corn, the highest we've ever been on July corn on the first day of the year was $5.92. This year we were $6.10 for July corn. That's not a major record, but that's still almost, it's 18 cents. When you look at, excuse me, that's Dees corn. Sorry, that's Dees corn. Higher than we've ever been by 18 cents. July corn is not a record. In 2012, we were $6.90. 2011, we were $6.73. And this year, we were $6.71. So, again, high, but not a record.
How does inflation change your thinking?
It's a great question. It's a great question. I'm going to do like what a lot of politicians do. I'm going to answer your question with a question. How much are you calculating in your farm today to hold corn for a month? It should be about a nickel, a bushel, every month. For beans, probably 9-10 cents every month. If you don't have that kind of basis appreciation in your mind, you should sell your corn and beans right now because you're not going to be able to pay for the interest costs that you have by not selling your grain. We have the highest interest rate we've had in 15 years. I know there are many in this room who have experienced higher interest rates than this. But there are a lot of people in the grain business who have been in the business for 15 years who feel like the sky is falling with 7 and 8% interest rates. They don't know how to calculate what it costs to carry corn and beans. It's a lot of money. And so when you say that the relative cost, it's really hard to answer that question in flat price terms. So there is a component of inflation in all commodity prices, no doubt about it. It's much harder to measure because it's got a whole lot of other factors involved, supply and demand and world things and weather and all that kind of stuff. But it also is how does the money that invests in commodities treat a commodity investment in a high inflation environment. And you don't generally want to be long commodities in a deflationary environment. A return on a hard asset investment is negative in a high inflationary environment. We have seen massive money leave the commodity markets all fall. We've had corn managed money positions cut in half almost from June to November. We've seen a lot of money leave because of the deflation trade, the deflation concern. Don't fight the Fed's interest rate policies. I don't want to be long crude oil. I don't want to be long corn, beans, wheat, meal, oil, anything because of inflation. Where do you want to put your money? Well, you can go buy a 10-year CD for 4.5% or something like that. We haven't been able to do that in 15 years either. So the money in the environment that we're in today is very different than what we've been in for the last 15 years, and it's a very important point to make. But I don't think we want to get too bogged down in the flat price, futures price being a major component of that, because there's too many other factors that go along with it. So high-low predictions. This is the next slide here real fast. You won't be able to read this, but if you were to take historically, for the last 32 years, this is on the left, last 32 years of corn price and bean price, what is the highs and the lows as a percent of the January 1 price? On average, it's 111% for the high on corn, which says the average expectation for July corn is 745. I said average, we're just talking math here. That means half the time you won't get to 745, the other half of the time you'll go over 745. This is just math. The average low over the last 32 years is 89% of the January 1 price. That's right at about $6. So if you were to ask us, or we get asked this all the time, what is your range for July corn over the next 5 months? I'm going to tell you $6 to $7.50, because that's what we've done in the last 32 years on average. On beans, same thing, same process, 110% of the January 1 price, 88% of the January 1 price. That gets you to $16.86 on July beans and $13.50 as a low. I have a bigger problem with the bean number because we have the highest bean number for January we've ever had by over $1. So we're adding 10% to the highest price we ever had in January 1. So that's a bit of a challenge on the high side for me. That's saying almost $17 is the average move. You know, I don't know if I'm going to wait around for $17 beans. I think that's a little bit too ambitious. When you look at new crop, same thing. We do the exact same method for new crop. Deece corn, it's 116% on average for the high. It's 80% on average for the low. That is a Deece corn target of 710 and a Deece corn low side of 490, almost $5. So we have half of the time the new crop corn price low has been 80% of the January 1 price, half of the time. And that's under $5 today. When you look at today's cost, you look at today's cost of money, cost of inputs, cost of land, cost of rent, none of them have gone down. At 490, it's going to be tough to make money. It's going to be tough to make money at 490. 5 years ago, you could have made money at 490, not today. Okay? So there is that downside risk, and we've done that half of the time in the last 32 years. When you look at beans, 113% and 87% for new crop. That's a $16 target for November beans on the high side and $12.31 on the low side. So this is just turning the last 32 years of prices and turning them into a math problem. That is all these last two slides have done. But I think it's a valuable set of goalposts to kind of say this is what we've done historically. I think if we get Deece corn above 650, we need to start taking some action. I think if we get November beans in the 14.25, 14.50 range, we need to start taking some action, which leads right into the JSA Select program, which I don't need to go through the overview of this. There's many in this room who have participated for many years in a row. We don't have much of a program left right now because we're in the middle of a sign-up period that ends January 31st. And URSA has always done a great job of getting this information in front of you. We have our 2-year corn program and 2-year bean program, which is for the fall of 23, that was signed up for last year, right? This time last year, if you committed to the 2-year corn and the 2-year bean program, you have bushels that we're managing right now for the fall of 23. Our position on fall of 23 2-year corn and beans is we're 50% sold. We're 50% sold at around $6 corn and around $14 beans, give or take a few cents. On top of that 50% sold, we also have done some re-ownership trades if the market was to rally going into the spring, that we would participate with some of that, and we're leaving the other 50% open. But we feel it's important enough at 14 and 6 to start thinking about layering in some floor type prices to protect a pretty expensive crop you're going to put in the ground this spring. In addition to that, on this Thursday's report, because we are 50% sold, which is pretty heavy, I don't want anybody to raise their hand, but I would say how many people in the room are 50% sold for next fall's corn and beans? There's probably not very many of you. There might be a few. We know that's a pretty heavily sold position. I do not know what Thursday is going to bring at all. So that call option trade I mentioned earlier, we're going to attach those to those 2-year corn and bean bushels. I'm going to spend 5 or 6 cents for corn and 8 or 9 cents for beans to see that report in case it's bullish. If it is a bearish report, that 6 cents is gone. That 9 or 10 cents on beans is gone. If it's bullish, we're going to run with it. But I'm willing to spend that little amount of money because we're so heavily sold for the fall. So that's our plan for this week and in that program. I just want to see what the price is on Thursday. I don't want to do it any earlier than we have to. Average performance. This is a 9-year history of JSA Select corn. The average price over the last 9 years of corn, this is every single day for 9 years. The average price is $4.32 futures. The average JSA Select price over 9 years, which is the fall, winter, and summer price for 9 years, so 27 prices, for the last 9 years is $4.68. We also throw the median price in here. The median means 50% of the days were above this price and 50% of the days were below this price. That's not the same thing as the average. It has to do a bit with how much time we spent below $4 in the 16 to 19 period of time. We spent a lot of days below $4. So the median price is $3.81. When you go to beans, Again, long-term bean performance of JSA Select. Our price over the last 9 years has averaged 1121, the top black dashed line. The average or mean price is 1080, and the median is 990. Again, 50% above, 50% below is 990. You all would know this if you've been in the programs, consistently throughout the years. There are some years that we're ahead of the market 50, 60, 70 cents. There are some years we've been behind the market 30, 40 cents. The fall of 19 was one of the most challenging years we had in JSA Select because we had very little opportunity from February 1st to August 31st to lock in a price that is anywhere close to what we were that fall. In 2019, we had the derecho in Iowa, which was in August, and we had China starting to buy massive amounts of corn in October, November, December. We had a 388 price, and that price in the fall of 2019 was accomplished between February and August 31st. The high that year was like 420. So if you say in the window that we had, the high was 420, our price was 388. That doesn't mean anything when you're harvesting corn and across the scale is 450. And that's what it was in the fall of 2019. So there is no silver bullets to marketing. I try to be as transparent as possible. There are times this program has worked better in years than in other years, but we do have a 9-year track record of being in the upper half of the price range on beans around 40 cents and on corn it's similar over that 9-year period of time. So that's the long-term history. I just have this last fall up here, which is the 1-year program of this last fall. We did pretty well. We'll say we did well in the years and we'll say we did poorly in some years, but this last fall we did pretty well. We were 726. The average price in October was 686, and the average price for the whole pricing window was 661. On the soybeans, we had a price of 1543 this last fall in the year 1 program. We were 1547 as the pricing window average, and we were 1382 for the October fall average. So we had a pretty good year this year for the fall. Last thing I'm going to say, and then I'm done. I don't know that you all know this. We've spent a fair amount of time, and I'm going to attest to a fair amount of money, in trying to be as transparent as we can with everything we're doing in JSA Select. URSA is one of the best companies that I work with at giving you the updates that we write. Whenever I forward an update that we made this sort of a trade, or it's a Friday update, we just kind of give you some thoughts about the market, what our next targets are. I send that to URSA, and Larry or somebody else forwards that out to all the participants. Not everyone does as good a job at that is in the program. We have about 52 companies right now that are in this program all across the country. We have an app that we made a couple of years ago. We've added to that app a JSA Select section. So if you download the JSA Today app, you can hit a button on there that says JSA Select, and you're going to see all of our trades. You're going to see all of our mark-to-markets, all of our notifications go right to that app. If you're like me and have too many apps, or you're like my mom and has way too many apps, you're going to get notifications right and left. Okay? Our notifications, you can turn them off. You can turn off all the notifications that we have, and if you just want JSA Select notifications, that's the only ones you'll get. So it's very customizable. You get free quotes. There's weather, there's USDA and NAS maps and all sorts of stuff on here, and it's free. Our app is free to all of our customers. And you are a customer if you fit into one of 3 categories. You clear your futures with us, which is what URSA does. You are a paid consulting client of ours, which we have many of, or you are enrolled in JSA Select. If you are in any one of those 3 categories, you download this app, we're going to get a notification that you downloaded that app. We're going to send you a password that's going to be a real simple 1, 2, 3, 4, 5 password, and you can make it your own, and you have the app for free. So the big key that I want you to take away from this is if you're involved in JSA Select and you want to see everything that we've done, there's a whole history of our trades, and every time we make a trade, you get an instant notification that day. The app is probably the fastest way to get it. Not to take away from Larry's efforts and others to forward you emails, but we have 2 different ways for you to get the information. What?
How about a letter, a mailed letter?
A mailed letter?
Very nice.
No, I'll tell you what.
Better leave it there.
That fax machine that has that rolling paper on it, I'll send it to you in a fax. I can only do this at this meeting because that's the only one my parents go to.
What do we look for on that Google Play Store?
JSA today. I'll talk to you afterwards. There was a question over here. Yes, sir.
What effect near term right now is river level doing on export stuff?
The river level being as low as it was, especially in the fall and into the winter, has had effects. It's had an effect, especially of very high barge freight, which has affected the basis along the river systems. No question about that. It has made us less competitive because that extra cost of barge freight gets transferred to the New Orleans price, that is the price that we compete with on a world stage, and we compete with Brazil and all the other countries. And if we have to spend an extra $1 a bushel for barge freight, that makes us less competitive. So there is no doubt it is having an effect. But I will be honest with you, as bad as it was in October and November, it has not been as bad in the last 5 or 6 weeks than we feared it would be, because we've actually had enough rain and enough at a timely fashion to where we might get a little scared about the water levels, and then all of a sudden we rise up 5 or 6 feet because a system came through. Right now, the river conditions, even though we're closed now on the mid-miss, but the river conditions in St. Louis and south and the Illinois River all the way to New Orleans are about as good as they've been in the last, since the fall. So they've been a factor, but they're improving. When we get to the spring, snow melt and all those types of things happen. The spring I'm not worried about. We're going to have water in the river this spring. But, I was worried what January and February are going to look like in October, because we are typically kind of dry this time of year. And we've actually we've had enough rain to kind of sustain us and actually improve a little bit. Any other questions? Yes, ma'am?
Are you going to share those options you're going to put on Thursday morning?
It's a real simple thing to share. So March corn is the options. What I'm talking about is a weekly option. It is technically the week 2 option, to be specific. It expires on Friday of this week. And I'm going to look at the price of March corn about 2 hours before the report. And if that is, let's say that price is $6.60. I'm going to look at the $6.60 call, what they call the at-the-money call. And right now, the at-the-money call is around 5 or 6 cents, and that's the one we're going to buy. Yep. And on beans, it's the same thing. It's whatever the price is of March beans at a couple hours before the report, because I got to have time to put all the orders in, so it's going to be a few hours before, and those are the calls we're going to buy. And then we're going to buy that against the JSA Select 2-year bushels, but there are a lot of people who like to trade this report. You can buy 6 cents for an at-the-money call, and you can spend 6 cents for an at-the-money put. You don't care if that report is wildly bullish or wildly bearish. You just want it to be wildly something. You're going to spend 12 cents in total. If the board goes more than 12 cents up or more than 12 cents down, you're making money. There's not many reports out there that you can do that on, because not many reports have the history of being as volatile as this one does. So we'll see.
Are you doing both, puts and calls?
No. The reason I'm not doing both is because I'm protecting a hedge position we already have, and that's already a short. I'm only doing the long side because I'm protecting the short hedges that we have. Yep.
Brian, what about, we saw now, we did lose some export competitiveness as far as the things that happened with the river on the corn. You kind of alluded to on the slides on there that looks like that will continue. You typically, most of the folks in here will deliver the river on here. Typically, that's the best market.
Correct.
Right now, there's a domestic market. There's a pretty big spread between the river and the domestic market. When do you see that closing? Do you see that closing?
I mean, the most likely time for that to be the narrowest on beans is during the fall and winter, because that's the peak export season for beans. So from September, October to January. The river market, if it's going to be competitive with the domestic market or even above the domestic market sometimes, not today, but sometimes, that's the time beans are most competitive. For corn, it typically starts around now and goes through June, because that's our peak export season for corn. I do think that those domestic and export values will come together as we get into Feb, March, April, because I think we're going to ship a lot of corn out of this country in that time frame, and we're going to have to compete with the domestic market on basis to get that corn originated. It does beg a longer-term question, but that longer-term question is, you know, how do you diversify as a company to not be so reliant upon exports and things like that? But it is a, you know, if you take the whole theme of the presentation, you know, from 10,000 feet, I think the value add domestically is going to be stronger than the value add export from just general agriculture. And there's no doubt that URSS is a pretty export-pointed company. So there's certainly some things to consider there.
Brad, you also talked about corn. You know, so where is the Brazilian corn going to? Who's buying it?
Everybody. Everybody. But yeah, I mean, China's the new one. Okay, so Brazil, the top amount of corn that Brazil has ever exported in a year, I think, is around 28 or 29 million tons, which is about 1.2-ish billion bushels. This year, they're going to export around 44 million tons. It is a big, big number. That's about 1.7 billion bushels. So they're exporting and trading with everyone. We have Brazilian corn going to Mexico. We're a lot closer to Mexico, but Brazil corn's going to Mexico. We have Russian wheat going to Mexico because it's cheaper than our wheat going to Mexico. That's how out of sync we are on the corn and the wheat side. But China, up until October of this year, had never bought a bushel of corn from Brazil. They never have. Brazil was not that big of a factor, and they've bought zillions of bushels of beans from Brazil, but they did not buy corn since October, or up until this October. And so far, they've already loaded about 65, 70 million bushels of corn to China out of Brazil since October. So it shows you, I mean, let's face it, we are China's #1 buyer of everything in the world. We buy more China stuff than anything else in the world. And they treat us, especially in agriculture, but in a lot of areas, it's amazing how hard they work not to trade with us. For us being as important as we are to buy all their stuff. So China is this, I don't even want to, I'll start cursing or something, but it's a very difficult partner to have in agriculture or anything for that matter. And China's buying from Brazil. They've bought a lot from Ukraine over the last years, and as Brazil and Ukraine grow, more and more corn to China is going to come from those countries instead of us. They've made that abundantly clear. They would rather buy corn and beans from about anywhere else in the world than us. And they're one of the biggest buyers. So that is a challenge that we have with China. My answer to that, and this was instilled in me as a very young child, if you look on the back of something that you buy anywhere in the store, look where it's made, and if it's not made in the USA, don't buy it. That's something I got from my dad.
He has nothing.
You might have to pay twice as much for it. But anyway, a little side note. Any other questions?
On the Mexican thing, we saw them before.
Yeah.
Are they going to be serious about this non-GMO thing?
It's a great question. I should have brought that up. It is kind of a topic of the day. China, I can't get China off the brain. Mexico buys about 18 to 19 million tons of corn a year. Until China 2 years ago, they were consistently the world's largest buyer of corn. They have made policy statements about going to non-GMO. It was going to start this year. They kicked the can down the road to next year. They've made a few tweaks to that statement to say it's only going to be for food consumption instead of feed. But it's all on the same train. It's all on the same boat. So if you're going to make that non-GMO distinction, it's going to have to be an identity preserved program. And there has never been an identity preserved program that's 18, 19 million tons big. The other option was white corn. All the white corn in the world is about 7 million tons, and half of that's grown in South Africa. So when you think about options that they have for non-GMO, it's not a realistic statement. Again, I think that is the Mexican president and the head of their ag department speaking to their audience a little bit, no different than the folks in Europe that spoke to their audience when they started naming things like frankenfoods and stuff like that. So but the reality is, unless they're willing to spend $1.50 to $2 a bushel more to identity preserve it all the way down to them for all those bushels, that's a very unrealistic thing. I'm not saying they can't do it, I'm not saying that they absolutely won't do it, but it is a very unrealistic undertaking. It's my opinion, okay? So this is just me talking. That's not going to happen. We're going to get to the 11th hour and something else is going to change. They're going to kick it down the road another year, and then there'll be another president. We'll never hear of it again. I mean, that's the most likely outcome, in my opinion, but it has caused a lot of angst recently, for sure.
Brian, we got some guys in the room that's got some winter wheat.
Yes. Winter wheat is a war trade, bottom line. If we continue to go through, I mean, we actually had a little bit of, Russia was a lot more aggressive with their bombing today than they were the previous week, but the ebbs and flows of that Russian-Ukrainian war in the Black Sea is going to be the ebbs and flows of wheat. Wheat is a very, very hard commodity to trade anyway, and it's nearly impossible today. I think we have just as much of a chance for wheat to see 10.11 again than to see 7.50 again in the next 6 months. And it all is going to be dependent upon, do we see Putin drop a bomb in Odessa and destroy supports and honor the grain corridor or not, is going to be the determining factor of the trajectory of wheat. It is a very difficult trade. I think for most folks, soft red wheat at these price levels is a profitable level, just from a production cost standpoint, especially if you follow that acre with beans. So again, I know this isn't a big wheat area, but historically, if you're going to get an 8 or a 9 in front of wheat, you normally just sell it. And if you get lucky, like last summer when it was 11 or 12, that's just lucky. That is not something that's typically going to happen.
Where's Australia on wheat right now?
Second largest crop ever, about 33 million tons. Their record's about 35. Australia has the opposite weather correlations with El Nino and La Nina. So we're entering year 3 of La Nina, which is a warmer equator water temperature reading. That has a tendency for a southwestern U.S. dryness, Argentina dryness, southern Brazil dryness, wet in Australia. El Nino, which is more favorable to Brazil and Argentina, and usually gives us a bit wetter spring and summer, is droughts in Australia. So we're still in a condition of El Nino La Nina is pretty favorable to Australia, and they have been getting reasonable amounts of rains. They have they're one of the larger, Russia's by far the largest producer of wheat in the world, almost 100 million tons. They're the largest exporter of wheat in the world by a long shot. Australia's a major player, but they don't hold a candle to the size of Russia. Russia's going to export 65 million tons. Australia's going to grow 33 million tons. So they're important, but the big dog is Russia. And they had a record crop. Over 100 million tons for the first time. The problem is it's Russia. What the heck's going to happen with Russia over the next however many months, right? So what that Black Sea looks like is a huge question mark. All right.
Brian, one more question for you. In your opinion, guys are holding on to corn and beans. What should they be holding on to? What kind of percentage? Or what kind of targets should you look at?
I would be much, much more heavily sold on beans. The bean prices we talked about, the highest ever for this time of year by over $1. We've had multiple opportunities to sell something with a 15 in front. I don't see much of a reason to be holding beans. Flat out period, I wouldn't hold them. I'd be 100% sold old crop. There's no reason. Turn it into cash. Earn 9 cents a month on interest, right? So on corn, I think there's a reasonable chance, 70-75% chance that we're going to see a 7 again in front of old crop corn. But again, we're already at the 660 to 670 range. It's not like we're that far away from that. And if it takes you 6 months to get $7, you're going to chew up 15 to 20 cents in interest. And again, I'm saying interest because you guys may not be thinking about this, but if you have a bin full of corn, that's earning nothing. If you have that bin full of corn in your bank account as dollars, it's earning something today. Maybe not in your savings account. I would not encourage that because I don't know, they're like ripping you off at banks for savings accounts. Put it in a money market, 3.5%, 4%. That's about 5 or 6 cents a bushel. You have to be earning that on your money or have expectations of getting that kind of a price rally to not sell your corn. So I would probably be at least 50 to 60% sold on corn. And if we see something close to $7 cash, I'm out for old crop corn. Yes, sir.
You're talking about $7 cash, what about basis? I mean, you think basis in March?
Well, I mean, it basis in March in Ursa, I mean, correct me if I'm wrong, Roger, but you guys are probably a little bit on and over for corn in the last half of March, or near it, right? Even-ish? Right?
Yeah.
About even? So, I mean, again, basis could be 5 over, 10 over type of numbers. They could be 5 to 10 under. There's a range in there. But I think in this neck of the woods, corn basis can be plus or minus 5 cents of even. So I'm still kind of looking at that $7 board here. You know, again, if this Argentina drought in January doesn't get any better, if it continues to get worse, I would put another 10 or 15 cents of upside on that basis, but that's contingent upon Argentine weather. I mean, it is not far-fetched at all to think versus the May, let's say in April and May, that we could see 10, 15 overs in Ursa. That's not out of the realm of possibility at all, but that depends on how bad is Argentina in the end, because they're the other major exporter. So in that case, we wouldn't have to get to $7 futures. Even a $6.90 or $95 would get you to $7 cash delivered. But this is the time of year to lock in the kind of profit that you have at those kind of levels and really start to focus on 23, because that's, to me, there's more risk in 23 than what you have in the bin today, and there's more risk in 24 than there is in 23. So to me, it's really starting to focus more forward. And I think this year, I don't talk to a ton of producers on a regular basis, but a lot of our offices that do, and they kind of collect some information from time to time, we probably have one of the smallest amount of producer operating note needs this spring than we've ever had. We have a lot of producers, and some of them are very large producers, multiple thousands of acres, that are not going to borrow a penny for this spring's crop. Okay, that's rare. The other thing that tells you is you're not feeling the interest rate pinch yet. When you start to borrow money, the interest rate really starts to kick into gear, because you've got $1 million operating loan and you're giving $70,000 away to interest in a year. That's a kick in the teeth. But we don't have a lot of people borrowing that much money right now, but it's a real number that's out there. I think we're just a little insulated still in agriculture because we're not borrowing much, because we've had a pretty good couple of years. That's all I got. Okay, thank you guys, appreciate it.
Thank you, Brian. Anybody has any questions at all for the locations or for Brian? Brian will be around here for a little bit. If you really like what you heard, and want to have another round of this presentation tomorrow too. So you're welcome to get those. There's a lot of information, there's a lot of things going on, and we do appreciate you taking the time. You know, our focus is not to push upon you, impress upon you, to pledge bushes in it. Our focus is to get you to be thinking about the opportunities that are in front. And there are. They're real today. They're strong opportunities. And it's nice on occasion to have these kind of outlook meetings and you have a bullish outlook, or at least a bright outlook. You know, the glass, too many times you get in where the glass is half empty. And we got all these challenges going on. And, you know, it's a good time to be an ag. And rightfully so. So we appreciate what you do. Be safe on your way home. If you think about things that you have questions on, don't hesitate to reach out to your locations or the folks here at URSA. So thank you. Thank you, Mike.